Stop what you're doing right now. Close every other tab. Put your phone face down, because what I'm about to share isn't speculation, opinion, or a headline you skimmed this morning. This is the result of 40 years of watching debt cycles rise, peak, and collapse. 40 years of steering billions through every major market disruption of our era, from Black Monday in 1987 to the dot-com crash, the 2008 financial meltdown, and the liquidity floods that followed. I've seen this pattern repeat across countries, currencies, and asset classes, and in 4 decades, I've never seen it resolve quietly. The math simply doesn't allow it. And right now, the math is worse than anything I've ever encountered. Here's the truth. Almost nobody says out loud, and maybe that's because it's too uncomfortable to admit, we are not approaching a credit problem. We're not teetering on the edge. The 2026 credit collapse has already begun. It started quietly, not with headlines or sudden crashes, but in the plumbing of the financial system, in areas most people never notice or question. By the time it becomes impossible to ignore, the window to protect yourself will have already closed for many. Let me start with a personal story, because it illustrates the most crucial lesson you need to understand. In 2000, I managed the Quantum Fund. For months, I warned about the tech bubble. I wrote memos, ran analyses, held meetings. I watched companies with no revenue, no path to profitability, and no coherent business model trade at valuations detached from reality. I was convinced the bubble would collapse, so I shorted those overvalued stocks, betting against them. My analysis was right, but here's the lesson. I still lost $3 billion in 6 weeks. Let that sink in. Being right doesn't mean you profit. Watching younger traders make enormous gains while my shorts underperformed, my ego overrode discipline. I abandoned my system, poured $6 billion into the very stocks I had warned against, and in 6 weeks, half was gone. $3 billion evaporated because I let others' behavior dictate my own decisions. I rebuilt the fund, but I never forgot that feeling, or the lesson embedded in that failure. It wasn't about market timing, it was about the psychology of crisis. When things collapse, the most dangerous impulse is seeing others profit while you protect yourself. That temptation will return in 2026 and 2027 stronger than most people have ever experienced. And I'm telling you now, before the pressure hits, exactly what it will feel like and how to respond correctly. Now, let's get into the numbers, because this is where reality gets uncomfortable. Total U.S. debt now exceeds $90 trillion. Government debt alone has crossed $35 trillion. To put that in perspective, if you had spent $1 million every single day since Julius Caesar crossed the Rubicon in 49 BC, you still wouldn't have reached $1 trillion yet. We owe 35 of those. But the number itself isn't the most alarming part, it's the speed. Interest payments on that debt have now surpassed what the U.S. spends on national defense. Read that again. The cost of servicing debt has exceeded the cost of maintaining the most powerful military in human history. In every debt cycle I've studied over 5 centuries, that crossover when debt service exceeds defense spending marks the terminal stage of a problem, not the beginning. It's the stage where 3 outcomes historically occur. First, default governments or institutions simply stop paying. Second, restructuring a negotiated rearrangement of payments. Third, inflation, a quiet default politicians prefer, which erodes debt value without technically breaking promises. Across history, those who survive and prosper during these transitions own real assets, not paper promises, and position themselves before the crisis becomes obvious. Those who fail are caught holding currency, bonds, or commitments that suddenly lose value. Understanding the mechanisms behind the 2026 collapse separates those who see it coming from those who are confused by chaos. The first mechanism is corporate credit deterioration. For the past decade, companies borrowed almost free money. Even weak businesses with mediocre models or poor management could access massive capital at near zero rates. but they rarely use that money to grow production, hire workers, or innovate. Instead, they bought back stock, paid dividends, and pursued flashy acquisitions that often destroyed long-term value. Now, as loans mature, refinancing is painfully expensive. Rates that were near zero are now 2, 3, or even 4 times higher. Default rates are climbing, credit spreads widening. These are the subtle tremors signaling a quake, and they're happening right now if you know where to look. The second mechanism is commercial real estate. It's collapsing quietly, and few appreciate how severe it is. Office buildings, retail centers, industrial, and mixed-use properties were priced during the era of near-zero rates under assumptions that no longer hold. Financing costs are now 5, 6, or 7%. Meanwhile, office occupancy hasn't fully recovered post-pandemic, and many analysts doubt it ever will. Regional banks, which fund small businesses and local developers, hold loan portfolios hemorrhaging value. They can't sell without triggering solvency risks, so they extend maturities, hoping rates drop fast enough to save them. Some loans may survive, many won't. As these regional bank failures accelerate, the resulting credit contraction will hit the very layer of the economy responsible for job creation and community activity the hardest. The third mechanism is consumer credit exhaustion. Headlines about low unemployment suggest consumers are fine, but that's misleading. Credit card balances are at all-time highs. Delinquencies are rising faster than 2008, and auto loan defaults are alarming. Buy now, pay later products once marketed as convenient now quietly hide growing delinquency. Household savings have been spent. The American consumer, who has carried the economy for the past 3 years, is running out of runway. When credit tightens and delinquencies force lenders to pull back, the growth figures everyone points to as proof of resilience will vanish. Next, timing matters. When will markets price this in, and how will different assets react? Markets can remain detached from reality longer than rational minds expect. I learned this painfully in 2000. Being early and being wrong feel identical in your brokerage account. I won't tell you the exact day the collapse will hit, but the window is measured in months, not years. Historical signals, credit spread widening, yield curve behavior, regional bank stress, consumer delinquencies are all aligning negatively. When multiple signals converge, history shows dislocations arrive faster than predicted and hit harder than models suggest. So, what do you do when you see these warning signs stacking up, and the world around you carries on as if nothing is happening? First, accept that uncertainty is normal, but inaction is lethal. Most people wait for confirmation, the official collapse, before moving. By then, the safest assets have already been claimed, cash has been diluted by inflation, and panic has driven prices to extremes. The advantage goes to those who position themselves before the obvious, not those who react afterward. Let's break this down into practical, actionable steps, because knowledge without execution is just anxiety. Step 1, liquidity. In a collapse, cash becomes king, but only if it retains value. Holding dollars in a normal checking account will protect you from immediate losses, but it won't protect you from the quiet erosion of purchasing power. Diversify the way you hold cash, some in stable currencies, some in instruments that preserve real value, and some in physical assets that remain tangible when systems fail. Remember, what's safe on paper isn't always safe in reality. Step 2, tangible assets. For centuries, during every financial upheaval, real assets have retained value where paper contracts failed. Land, precious metals, certain types of real estate, and commodities have one thing in common: they exist independent of government's promises. Not all assets are equal, and not all real estate is safe. Look for scarcity, utility, and intrinsic demand. Buildings people need, farmland, energy infrastructure, these withstand shocks because people always need them, even in crisis. Step 3, credit exposure. This is where most professionals and everyday investors fail. Banks, corporations, and governments are all over-leveraged. If you hold bonds, loans, or derivative positions, understand exactly who owes what and when. Small miscalculations can turn a secure investment into a catastrophic loss. Margin is particularly dangerous. A small market move can wipe out years of gains. The only positions that survive severe dislocations are those structured to endure stress, not those optimized for short-term yield. Step 4. Skills and networks. Money alone can't buy resilience if you don't know how to use it. Skills that are in demand during crises, logistics, medical support, energy, repair, communication, become as valuable as any financial asset. Connections, community, and reliable networks act as force multipliers, providing access to resources that markets temporarily fail to allocate efficiently. I've seen fortunes vanish and reappear based solely on who you know and what you can do when systems break. Step 5. Mental discipline. Markets are not just numbers, they are human psychology in motion. Fear and greed drive prices far beyond reason in both directions. When panic sets in, the strongest portfolio may falter if the owner panics first. You must be able to observe fear without succumbing to it, to act decisively when others hesitate, and to avoid the trap of envy when people make money on short-term moves. This is where decades of experience matter. Your emotional reflexes can cost more than any spreadsheet or model ever could. Now, let me tell you something few people understand. Crises are also opportunities. History is littered with examples of individuals who grew stronger and wealthier during periods when the world around them seemed to collapse. But there is a pattern. They were not lucky. They were prepared, disciplined, and observant. They recognized signals before the panic became obvious. They acted before the herd. And they survived by thinking in decades, not months. I want you to picture this scenario. Interest rates spike, regional banks fail, consumer credit freezes, and corporate defaults accelerate. Stock markets plummet, but certain assets, farmland, energy infrastructure, precious metals, essential commodities retain value. People panic. They sell everything they can to raise cash. You are calm, you are ready. You don't chase losses, and you don't panic when headlines scream catastrophe. You act in the shadows of fear, positioning yourself for the next cycle, understanding that every collapse in history has produced the next wave of opportunity. But there's a nuance most people miss. Timing is not just about when to buy or sell, it's about understanding sequence. Markets and economies do not fail all at once, they crumble in stages. Credit markets first, then consumer demand, then corporate overreach, and finally currency and sovereign risk. If you prepare for stage 1 and ignore stage 2, you can still lose everything. A collapse is a domino chain, and knowing which domino falls first and which falls last can mean the difference between survival and ruin. The next 6 to 12 months will test everyone's ability to read these signals. Those who understand corporate debt, regional banking stress, consumer behavior, and the interplay between government policy and market reaction will navigate the storm. Those who dismiss early warnings will be caught in the tide. I've seen this play out in every major crisis, and the lessons are immutable. You cannot wish away leverage, you cannot legislate away math, and you cannot predict human behavior perfectly, but you can prepare, hedge, and act in ways that preserve wealth and security while others scramble blindly. Now, let's dig deeper into specific asset classes, what actually survives when markets implode and what evaporates into thin air. First, consider equities. Stocks are the most visible measure of economic health, but during a collapse, visibility can be deceiving. Market prices often reflect sentiment, not fundamentals. Many blue-chip companies seem stable on paper, yet when credit tightens and supply chains break, earnings projections crumble overnight. Only companies with real cash flow, essential products, and low leverage can weather the storm. Even then, patience is required. Prices may oscillate wildly before stability returns. Next, bonds. Many investors treat government bonds as risk-free, but in a severe credit or currency crisis, that assumption falls apart. Sovereign debt is only as strong as the issuing government's ability to pay. Inflation, political instability, and over-leveraged fiscal positions can wipe out nominal returns. Corporate bonds carry similar hidden risks. Understanding the fine print, the maturity, seniority, and covenant structure is critical. Blind faith in safe instruments can lead to ruin faster than reckless speculation. Then, precious metals. Gold and silver are historically reliable during periods of monetary chaos. They retain intrinsic value because they are universally recognized, scarce, and outside the direct control of any one government. However, metals aren't cash. They need to be stored securely, transported safely, and liquidated wisely. Their strength lies in preservation, not rapid profit. They are insurance for your wealth, not a shortcut to overnight gains. Real estate is another nuanced topic. Location, utility, and scarcity determine survival. Vacant land in declining regions offers little protection. Farmland that produces food, properties in essential urban areas, and buildings with high-demand tenants tend to maintain or even increase in value during crises. Real estate also provides leverage, but leverage is a double-edged sword. A misstep in debt management can turn an asset into a liability. Cash flow matters more than speculation. Income-producing properties often outperform speculative ones when economies falter. Commodities beyond metals, like energy, food staples, and critical industrial inputs, also show resilience. These are items people need regardless of the economic climate. Energy infrastructure, for instance, may require upfront investment, but it provides essential services that don't disappear in a downturn. Similarly, agricultural assets or food reserves retain value because scarcity amplifies demand. Understanding the underlying utility of an asset is far more important than chasing headlines or market hype. Then there's the human element, the skills, networks, and knowledge that allow you to access or convert these assets efficiently. In past crises, wealth wasn't just about what you held, but how quickly and wisely you could deploy it. Someone who understands trade, energy, logistics, or emergency medical support could convert scarce resources into essential services, and essential services always hold value. Your adaptability, practical know-how, and connections multiply the security of your financial portfolio exponentially. Now, consider timing again, because it's everything. Knowing when to convert one type of asset to another, or when to hold, is often more important than the asset itself. Panic creates forced sellers. Opportunities arise in those moments. But acting too early or too late can be equally dangerous. The window between too early and too late is narrow and unforgiving. Observing market signals, political shifts, and economic stress indicators is crucial. It's not about predicting chaos perfectly. It's about positioning yourself to thrive when chaos arrives. Psychological resilience plays a role here too. Markets are driven by fear and greed, and emotions amplify price movements. You can survive with assets alone, but to profit, or even just preserve, you need calm, analytical judgment. History shows that those who panic first often lose the most, even if they started with the best positions. Discipline and patience separate survivors from victims. One final point on assets. Diversification isn't just a cliche, it's survival strategy. But real diversification goes beyond spreading across stocks, bonds, and real estate. It's about balancing tangible versus intangible assets, liquid versus illiquid, essential versus speculative, domestic versus global. True diversification hedges not just against market moves, but against systemic collapse, political shifts, and social unrest. It's a multidimensional approach, not a simple allocation. By combining preparation, diversification, liquidity, and psychological readiness, you create a protective framework. A framework that lets you move when others hesitate, secure assets others abandon, and act decisively when opportunities emerge in chaos. The collapse isn't a single event, it's a sequence of stresses and dislocations. The person prepared for that sequence, both mentally and materially, doesn't just survive, they have the rare chance to emerge stronger than before. The harsh truth is this: most people will be unprepared. They'll cling to old assumptions, ignore warning signs, and misjudge the fragility of their assets. But history also offers hope. Those who pay attention, who prepare, and who act calmly in the shadow of fear rarely fail entirely. Their wealth, freedom, and stability may not be guaranteed, but the odds are dramatically in their favor. And that edge, the ability to read the currents while others flounder, is more valuable than any single asset class.